let's also talk about what's happening in the markets from here on. A lot of geopolitical concerns that the world is dealing with right now. You're talking about Israel, Iran as well. And we've just gone down with something with India, Pak. How are you looking at markets and the geopolitical situation? Because right now you're seeing Indian markets which are resilient.
So undoubtedly, geopolitics right now is fairly tense. Russia, Ukraine, Israel, Iran, Israel, Hamas, Indo-Pak, China, Taiwan. These are all the flashpoints, and one can never predict what happens over there. Clearly, we have to focus on building portfolio which will be resilient to geopolitical situation. Now, can we be 100% immune? Answer is no. But by focusing on quality management, diversified portfolio, and reasonable valuation, hopefully we will be able to build some immunity vis-a-vis the geopolitical situation. The second and more important thing is to manage investors' expectation. Most of the time when people anticipate something, the reactions are far more moderate. So we are also sharing with our investors that you have to moderate your return expectation. While domestic fundamentals are good, geopolitical situations are ever changing and fairly tense. And hence, please follow the dharma of your asset allocation. This is fairly valued market, neither expensive nor cheap. Moderate your return expectation, have neutral allocation to equity, be a little bit overweight large cap and little bit underweight small and mid cap, and use correction as an opportunity to further invest into the market.
Okay. And if you have to look at valuations currently, Nilesh Bhai, where do you think we are? Would you say this is somewhere on the verge of normalizing and a time to accumulate from a longer term perspective? Or would you be of the opinion that we are still expensive, taking into consideration you're asking investors to actually normalize their expectations in terms of returns?
So again, you can view this valuation paradox in multiple way. One is, let's say, sectorally, there are sectors like defense which are very highly valued. And there is, let's say, sector like consumer discretionary, which we believe is fairly valued. There are hardly any sectors which are cheap right now. So one has to moderate the return expectation or increase the risk appetite to invest into market today. We believe this is time to go for fairly valued, reasonably valued companies, or companies where you believe growth will outperform market expectation. Today, banking and financial services, chemical, consumer discretionary space are the sectors where these opportunities are far more present. Defense is one sector where probably opportunities are less present. The second way to look at this whole valuation paradox is again large, mid, and small. Mid and small are growing at a faster pace. Large cap is growing at a slower pace, but there is more stability. So how do you create that equilibrium between large, mid, and small? Our view is be marginally overweight large cap, be marginally underweight small and mid cap. And finally, the portfolio flexibility. Please keep some dry powder, keeping in mind this geopolitical situation, whereby you can invest during a corrective phase.